we are back with Steve Gibson, our Chief Investment Officer. And Steve, over the last couple of weeks, you've talked about, the reduction in our value stocks and the reduction in international stocks, going more towards growth-oriented investments. I guess the number one thing that I hear today is from our clients is, I'm still real nervous about what's going to happen over the next 3, 6, 12 months. There's just so many different factors that are going on today relative to, what investors are looking at and should be prepared for. As you think about the next period of time, what thoughts do you have, and what additional action steps are you thinking about taking?
Right. Well, one is I do think clients might misunderstand, because we're in a large holding like the Qs, that we're being aggressive. And how would you be aggressive in the middle of all this? We've got an election coming, which is very uncertain, and we've got markets at all-time highs. There are two things I think about with that. One is this amount of interference from the Fed is unprecedented. I mean, they've put enough money in the economy for about a quarter of the economy. I mean, they literally have bought our way, if you would, through. And the market can see that. And so they're going to continue to sustain the stock market, even when things crazy are happening with the pandemic and the election. That's probably the most likely outcome we're going to see. But also, if there is a strain and it doesn't do that well, the companies that do have growth in earnings, as we've seen, are the narrow part of the market that's holding up the best. So it's actually by going larger with the large companies in the Qs and going with real companies with real earnings, we're actually playing a form of defense with that. It's not that we know that technology will keep roaring. It is at high prices, but we know there are real earnings there, and therefore it has much less downside. Whereas if we don't get the pandemic under control, or there is a lot of chaos about starting the economy, I just don't know when we'll get back on airlines and take cruises and go to Vegas and restaurants. That I'm less certain of. So I really don't want to time my way into thinking that's just going to come right back.
So this market really has surprised us with its recovery, of how quickly it actually has recovered. But if you think about it, a lot of the recovery is in a very small segment of the market. How do we protect ourselves, or how do we think about when this big potential crisis occurs that everyone's talking about?
Right. Yeah. What I look at is really, when people say, wow, 25% of the earnings are coming from 5 companies and things like that. Well, and that's where the prices are going up. I'm okay as long as those are the companies with earnings, and they are. The companies that are doing well because they are the ones making profits. They're even benefiting. Amazon and Microsoft, they're benefiting. DocuSign, these kind of companies, they're actually doing better than normal because of the pandemic. What I don't really want to do is guess on when things will turn around and I should, buy a casino stock that's off by 90%, And one of the things I'm watching a lot is the world has opened up again in places like China. So I'm very interested to see how fast Chinese go back to the restaurants and the movie theaters and so forth. And it's sluggish. For about 5 or 6 months, some of those companies are still off 70%. So I think we're in for a long slug. And in that environment, I prefer to be with real growing earnings in this environment.
So in the past, our strategy has been basically to own mutual funds and ETFs, and in a traditional asset allocation model. I think based upon what we've learned over the last several weeks, we are making some changes to that asset allocation model. But Steve also wants to introduce potentially some hedging strategies. Can you just give a little bit of explanation as to how that may work and how that may help to provide some defense in our clients' portfolios?
Yeah, let me first say one of the things that has been a part of the Hoover philosophy I share is stay away from the latest thing that Wall Street can think up, or very expensive hedge funds with high fees and all of that stuff. So I'm always very reluctant. But once in a while, there is a tailored product that can really address a specific need. And generally I'll take a couple of years even before I get comfortable with those and pore over them and watch how they do in different scenarios. There are some things that we can look at out there, and they may be just right for this environment because they're kind of built for high degrees of uncertainty. Let me mention one interesting product, which is JP Morgan's hedge equity product. So this product is designed if you believe the market only can go so much higher. I think that's where we are. It's really at record levels. How much higher can it go? It could go, I expect it will continue to move a little bit higher, but at these levels in this environment, I think there's only a modest upside. But I would like that because I want to, if I have a large account, those extra few percent really add up. But I don't want to have any kind of severe downside. I don't want to go down 15% or 20%. And so what the JP Morgan Hedge Equity Fund does, it gives you approximately the S&P 500 from plus 5% to minus 5%. So if the market goes up by 9, you don't love the product because you're probably going to get 5. But you're willing to do that because it protects you. Once the market goes below 5%, any decline of up to 20% more is completely hedged out. So if the market goes down 15%, you're only down 5. So therefore you can come back really quickly. I think it's kind of ideal because I think with the pandemic and with the uncertainty over the elections that I think we'll get through those fine, but I'll give up that upside. I'm willing to bet we don't have a real big upside in the market because I don't want to go through another down cycle, the severity of which we went through early in the year.
This product sounds ideal for our clients. Most of our clients are more on the conservative side. So certainly taking more of a defensive posture relative to large companies with good earnings and good profits, and now potentially adding another product like that to provide some defense on the downside. Where would you see that money coming from, and how much might we be investing in something like that?
Right. Well, we still have some small cap value, and I'm a little concerned that those companies which are at bargain prices, it may be a while until they get fully recovered. And there's some other value holdings that we always want to hold some value because if the economy does get its stride again, you want to have some. But we have still some healthy positions in like mid-cap value, for example. I think it'll be a while until those stocks really get their strength back. So I would probably be taking funds from those areas and perhaps some of the blend funds, which are half value, half growth. So we would probably take some of those assets as well to get a meaningful position over the next 6 months that would allow some real buffering against really one of the craziest times in 100 years. So I think that may be a good idea.
And do you see this as a long-term solution to our product and one that you might maintain for a longer term, or is this more of a short term or unknown at the time given the circumstances?
Right. In the short term, it is a bridge. It's a bridge past a really crazy election, and it's a bridge past a pandemic where we don't know, when we're going to get this thing thoroughly under control in the U.S. So those are two very strange, very rare kind of things to get through. So I think for this time period, it is a bridge. Longer term, we will be evaluating it in a totally different way. Is it also an alternative to using only bonds, which are excellent for playing defense, but does it have part of the solution to the very low returns we're seeing in bonds? Could we use it? Because it would have beaten the bond portfolios over the last 4 or 5 years. So that's a longer term thought, and we have a lot of evaluation to do. So for now, it's really a bridge past this next 6 months.
I think that, again, the number one question that I get from my clients is, please, Pete, help me to protect myself and my portfolio. And it sounds like this product might be something that's very appealing to a lot of our clients. Again, please talk with your planners, talk with your advisors, and we'll be giving more information about this, in subsequent letters and emails. Thanks for listening.